Hello and welcome. I'm on page 79 of your course pack, and I'm going to be talking about the classified balance sheet in this lecture video, okay? Well, I'll also do some practice problems associated with the classified balance sheet. So what we've been talking about so far in this course, or what I've been showing you so far in this course, is the unclassified balance sheet. So we show assets, liabilities, and they're very broadly grouped. There hasn't been an attempt, or we haven't gone through and said, all right, these are called our current assets, and these are our long-term investments in plant assets and intangible assets. We haven't classified our assets. We just said, here's our assets. Same thing with our liabilities. With a classified balance sheet, we're going to organize our assets and liabilities into subgroups, okay? Specific categories. And so with the assets right over here, we have current assets and we have non-current assets. And under non-current assets, we have long-term investments, plant assets, and intangible assets. And with our liabilities and equity account, we have current liabilities and non-current liabilities. Now, when it says current assets and current liabilities, current items are those expected to become due, both collected and owed. So it means we're going to collect on some of those assets or accounts receivable, or we'll use the supplies within 1 year or the operating cycle, whichever is longer. Okay. For the context of this chapter, I think a year is a fine way to think about it. It's a fine way to frame it. Okay. So think about it in terms of the year. So current items are those expected to come due, that we will, and more specifically, that we will either pay or collect on in a year. So examples of current assets. So let's talk about current assets. Some examples of current assets: cash and other resources that we expect to collect in a year and turn into cash, or the operating cycle, whichever is longer. Again, think a year. Examples are cash, accounts receivable, inventory, prepaid expenses, short-term notes receivable. Supplies is another one. Supplies is another current asset, okay? Non-current assets have 3 subcategories. So assets are divided into 2 subgroups: current assets, non-current assets, and then non-current assets are further divided into long-term investments, plant assets, and intangible assets. Long-term investments include notes receivable, and then if a company has some excess cash and they want to invest in a key supplier, for example, they could purchase the stock or bonds of a key supplier. They could invest in another company. So another company that they might want to think about doing that with would be a key supplier. Plant assets are those long-term assets that are used to produce or sell our products or services, and they span over multiple accounting periods. And we talked about some of this back in chapter 3, gave our examples of some plant assets, buildings, land, machinery, equipment. And then we order those from most to least liquid. How fast can they be turned into cash? That's liquidity. Intangible assets are those long-term resources that benefit an organization similar to plant assets, but you can't touch them. A building is a tangible asset. That's why it's classified under plant assets. I can come and touch a building. I can't really do that with the trademark or copyright. Those are intangible assets, okay? They lack a physical form, so patents, trademarks, copyrights, goodwill, licensing agreements. Okay, those are examples of intangible assets. And so that's on the asset side. Let's talk about the right side of the accounting equation with liabilities. Okay, we have current liabilities, and then we have long-term liabilities. Current liabilities are those obligations, those liabilities that we expect to pay within 1 year or the operating cycle, whichever is longer. Examples: accounts payable, notes payable, wages payable, salaries payable, interest payable, unearned revenue. Long-term liabilities we expect to pay longer than a year. Okay, so think 5 years from now, we have to pay some liability. Okay. That'd be a long-term liability. Examples: notes payable. If we issue bonds, we have bonds payable. And then also lease obligations. Okay, those would be examples of long-term liabilities. So if we look at this example right over here, this is our example of a classified balance sheet. We see that we have our current assets, and then as our header here, we have our assets first, and we have our current assets. We show cash at $6,500, short-term investments $2,100, accounts receivable net $4,400, merchandise inventory $27,500, prepaid expenses at $2,400, gives us our total current assets of $42,900. Then we have our long-term investments, our notes receivable, investment in stocks and bonds of $18,000, notes receivable of $1,500, land held for future expansion of $48,000, total long-term investments of $67,500. Then we have our plant assets, $203,200 for our equipments and buildings, less our accumulated depreciation, gives us our equipment and buildings net of $152,200. That's the book value. We talked about that back in chapter 3. The cost minus the accumulated depreciation gives us our book value, $152,200. Remember, that's the number that comes into calculating total assets. We also have land of $73,200. Land is not depreciated. That's why it's not included up here. Land is not depreciated. That's something we'll talk. It's assumed to have an indefinite life, and that's something we'll talk about more in chapter 10. We can add our book value of our equipments and building plus our land, gives us our total plant assets of $223,400. Then we have $10,000 worth of intangible assets. We add our current assets of $42,900, long-term investments of $67,500, then our total plant assets of $223,400, and then our intangible assets of $10,000, gives us total assets here in our example of $343,800. Then we look at the liabilities, and we have our current liabilities of accounts payable, $15,300, wages payable of $3,200, notes payable of $3,000, and then it says right over here we have a current portion of long-term liabilities. So what this is telling you is that we have some long-term notes payable, for example, but we have to pay some of that notes payable in the next year. So what we're going to do is we're going to take that out of long-term because it's due. We have to make a payment on that. It's due this coming year, even though it's long-term, right? We're going to take some of it is due in 5 years, but part of it is due this coming year. So we have to take the part that's due this coming year and move it to current. So it's the current portion of our long-term liabilities. $15,300 accounts payable, $3,200 wages payable, $3,000 notes payable, $7,500 current portion of long-term liabilities. We add up all those, we get our total current liabilities of $29,000. And then we have our long-term liabilities, which is after that $7,500 that was moved to current of $150,000. That gives us our total of liabilities of $179,000, and then we have our total capital of our $164,800 plus our liabilities of $179,000 gives us our total liabilities and equity of $343,800. All right. Then we can look at our current ratio. Why do we actually have a classified balance sheet? That's something we should talk about for a second. Well, a big reason that we have a classified balance sheet is that it helps us to calculate financial ratios easier. Financial ratios help investors, shareholders, creditors to quickly assess the financial standing of an organization. In one of the ratios that investors and shareholders and especially creditors would use is the current ratio. And the current ratio is calculated by dividing current assets by current liabilities. And it's a measure of a company's ability to pay its short-term debts. Okay, current assets divided by current liabilities is our current ratio. Now, if you look at our classified balance sheet here, it's easy to calculate the current ratio because it shows me right over here my current assets, and it shows me right over here my current liabilities. If I had the unclassified balance sheet, now I have to go through and classify each asset as current or non-current. and each liability as current or non-current. So you've made it harder for me. But if you have given me the classified balance sheet with it already broken out, now all I have to do is take the 42,900 divided by the 29,000, and that is my current ratio. Okay, that is my current ratio. Typically, you want that at least at 2. Okay, so 2, use your current ratio. If this dropped below 1, that means your current liabilities exceed your current assets, and that's a big problem, because you may not have enough current assets to meet your short-term obligations. All right, so then usually becomes, can you make payroll? Can you pay for your utilities expenses? That's the problem. So here we have an example of calculating our current ratio. So I'll just look at 2009, for example. I have my current assets of 2,867, my current liabilities of 1,225. I divide the 2, I get 2.3, and then I could compare that against the industry current ratio to give me some context to see whether I'm good or bad. And in this context, it looks like I'm better because I'm higher than the industry standard current ratio, and not by too much. The current ratio 2, around 2 is good. Okay, and again, that does depend upon the industry, and so that's why you always want to look at the industry current ratio, but I would say at least 2. All right. So let's look at page 83, where we have a practice problem. It says all of the following are true except what? The current ratio is calculated by dividing current assets by current liabilities. That is true. Current ratio helps to assess a company's ability to pay its debts. Yes. The current ratio does not affect a creditor's decision. Yes, it does, so that's not correct. The current ratio can affect a creditor's decision about whether to lend money to a company. Yes. And it can reveal problems if it's less than 1. That means current liabilities exceed current assets, and that's a problem. So that is also true. The one that's false is C. All right, so here's what I want you to do. Using the classified balance sheet from 2 pages ago in your course pack, I want you to take this adjusted trial balance and go ahead and prepare a classified year-end balance sheet. So for example, that cash would be a current asset, accounts receivable is a current asset, prepaid rent, current asset. Now, before we do that, here we have our long-term note payable, $52,000, and $7,000 installment is due within 1 year. That means $7,000 is going to be current, just like we talked about on that prior page using the current portion of long-term liabilities. That's what that is. That means you take the 52 minus the 7, which is going to give you your $45,000, which is going to be your long-term liabilities. Okay? So go ahead and prepare the classified year-end balance sheet. You also need to, before you, in the process of doing this, I also want you to calculate the current ratio, but to figure out ending balance and equity, capital, you have to take your capital here plus your net income and minus your withdrawals. Okay? And that's what you have to do to figure out the ending balance and equity. Capital here plus net income minus withdrawals will give you the ending balance and equity. Okay, so pause the lecture video, give it a try. Thanks. Okay, so the first thing I want to go over is how to calculate the ending balance and capital. So remember, we had the beginning balance and capital from the adjusted trial balance, and then plus my net income, took my revenues minus my expenses, gives me my net income of $262,800, and then I take that plus my net income minus my withdrawals of $200,500, gives me ending balance and equity $1,072,300. And then here is my answer. I have my cash, accounts receivable, prepaid, and then my office supplies, total current assets of $134,300. I have my plant assets right over here, and I do have to subtract out my accumulated depreciation, my land, total plant assets, total assets, my accounts payable, and all my other current liabilities long-term, and then my ending balance there. Thanks.